All right, today we're diving into DigitalOcean. They just dropped a fantastic quarter that gave the stock a nice little bump. But the real story here isn't just the earnings beat. It's their massive pivot towards AI and a super ambitious plan to chase 30% growth. So let's break it down and see if they can actually pull this thing off. Yeah, the stock jumped almost 6% after they reported, and that's great for shareholders. But the headline you really need to pay attention to is this bold plan to crank their growth rate all the way up to 30% by 2027. So the big question we're asking today is this for real? And is the market missing the boat on this long-term story? And if you want to understand that ambition, it all starts with this one incredible number, a 150% jump. That's the year-over-year growth in annual recurring revenue, or ARR, from their AI customers. Just think of ARR as the steady, predictable cash they're getting from this group. A number like this is absolutely explosive, and it shows a massive shift in their business. It is the engine for their entire new strategy. Okay, but before we jump into the future, we have to look at the quarter that just happened. And honestly, the top-line numbers were just plain strong. They beat Wall Street's expectations pretty much everywhere that matters. So let's look at the details of that beat. Their non-GAAP earnings per share came in at 44 cents. The analysts were only expecting 38 cents. That's a solid 15% surprise. And revenue was strong too, beating by almost $5 million. Look, these aren't just rounding errors. This is a clear sign that they are executing really, really well in their core business. And profitability? Well, that was another huge highlight. The company put up a super healthy 41% adjusted EBITDA margin. Now, that's a key metric for a company's operating health, and it shows that even while they're investing like crazy for the future, they're keeping a really tight grip on their finances. And this number, this just perfectly shows the momentum they're building. They added a record $51 million in new organic recurring revenue. That's the highest in the company's entire history. It's even higher than during the crazy peak of the COVID boom. It tells you that customers, both new and old, are adopting their platform faster than ever. And finally, a 59% gross margin just ties a bow on the whole thing. It completes the picture of a really solid financial quarter. They aren't just growing for the sake of growing, they're doing it profitably. And that sets the stage perfectly for the big strategic shift we're about to talk about. All right, now for the core of the story. DigitalOcean is not just a simple cloud for developers anymore. No way. They are aggressively remaking themselves into the main platform for the next wave of AI apps. Their name for it is the agentic inference cloud. So what on earth does that actually mean? Well, think of it this way. They're not just renting out powerful computer chips, GPUs, for AI training. Training is like teaching the AI model how to think. They're focused on AI inference. That's when the model actually does the work, answering your question or making an image. DigitalOcean is building the entire workshop for that, combining the AI part with all the other cloud stuff an app needs to run. This slide just perfectly sums up the transformation. The old story for DigitalOcean was that it was a great starting point for developers, but once the company got big, they would graduate and leave for a bigger provider like Amazon or Google. The new reality? It could not be more different. Their biggest customers, the ones spending over $1 million a year, had zero churn last quarter. Zero. Their growth is now coming from huge production-level AI applications, not just small-time experiments. And here is the proof right here. The recurring revenue from those $1 million-plus customers grew a jaw-dropping 123% year over year. This isn't just them patching a hole in the boat. They've turned what used to be their biggest weakness into their most powerful engine for growth. CEO Patty Shiny Vosin said it perfectly on the earnings call. This quote captures the entire strategic shift. They've solved that old graduation problem, and now their biggest customers are actually their fastest growing ones. So the past quarter was fantastic. The strategy is super clear. But what about the future? Well, this is where it gets interesting. Management's guidance is giving investors a classic choice. Are you willing to sacrifice some profit in the short term for a shot at much, much bigger growth down the road? And that whole debate is captured right here on this slide. Look at the top line. Revenue growth is set to accelerate to around 21% for next year. Awesome. But then look down. The profit margins are guided down, and the full-year earnings per share number is way lower than you might expect after such a strong Q4. So investors are seeing faster growth but lower profits, and that creates uncertainty. This is the tension at the very heart of this stock right now. And here's why it's happening. They are spending a ton of money to bring 31 new megawatts of data center capacity online to handle all that AI demand. The thing is, those costs hit their financial statements before the revenue from them shows up. That's what causes the temporary dip in profits. Management is being super clear about this. It's a deliberate choice. They're investing now so they can exit next year growing at over 25% with that big, bold ambition of hitting 30% growth in 2027. Okay, so let's zoom out for a second. We've looked at the company itself, but how is it doing compared to the rest of the market? Because this context is really, really important. This chart tells such a powerful story. Over the past year, DigitalOcean stock is up almost 43%. That's more than double the return of the NASDAQ 100. But here's what's even crazier. Compare it to the broader software sector. That's the IGV fund, which is down over 18% in the same time. So in what's been a really tough market for software, DigitalOcean has been a massive outperformer. All right, we've gone through the strong quarter, we understand the big pivot to AI, and we've digested the guidance. It all comes down to this. What's our call on the stock from here? We are rating DigitalOcean an outperform. We believe the market is way too focused on the short-term margin dip and is seriously undervaluing the long-term growth acceleration story that's unfolding. So here's our thinking in a nutshell. First, this AI strategy isn't just talk. That 150% growth in AI customer revenue proves it's working. Second, we think the guidance shows a smart investment, not a business problem. The market is getting hung up on the temporary earnings hit, and that creates an opportunity. We think if they execute, that 30% growth target is absolutely on the table, and the stock is going to get a major reevaluation. So if you're following them, keep your eyes glued to their AI revenue growth, their net dollar retention that shows how much existing customers are spending, and of course, that count of million-dollar customers. So how might you play this? Well, the core idea is to use any dips in the stock, dips caused by those short-term margin worries, to build a position. For those who are comfortable with more risk, looking at long-dated call options could be a way to get leveraged exposure to this multi-year story. But you have to be aware of the risks. They have to execute this massive capacity build-out, competition from Amazon and Google is always going to be fierce, and a big economic slowdown could hurt cloud spending across the board. And finally, we have to end with this crucial reminder. This is our analysis, but it is not financial advice. We are providing this for informational purposes only. Please always do your own research before making any investment decisions.